Okay, here's where we left off in part two. These are assumptions, principles, and constraints that were listed with the previous framework, and they're not specifically, other than the cost-benefit constraint, they're not specifically listed, but some of them are part of other pieces, and some of them are still considered important for making standards that become GAAP. And so we're going to go through all of these things, except the materiality, which we had already covered. So our assumptions, there's 4 assumptions: the economic entity, going concern, monetary unit, and periodicity assumptions. The economic entity assumption assumes that the company's activities are separate from the owner. And we have talked about that since the beginning of Accounting 101, how whenever you had, say, an owner investment, you had to determine from the eyes of the business, is the business receiving the cash, giving up the cash, or whatever. We don't care about the owner, and whether they're receiving or giving up cash, or whether they're spending it on groceries, whatever. We keep the business activity separate, and that's what our accounting is about, what's going on inside that business. Now, this also applies to maybe a corporation that has subsidiaries, and so we have all kinds of standards and rules about how and when to include what goes on in the subsidiary into the parent, etc., etc. So this economic entity assumption we have to make an assumption that the business that the financial statements are on is the business that these economic things belong to. The going concern assumption means that we have to make an assumption ahead of time that this company is going to continue. So if you knew that the company was going to go bankrupt tomorrow, then the values that you put on the balance sheet or how you're going to report things, all of a sudden you need to do things differently. So we have to have this assumption that this is a company that's continuing forward. It's not going bankrupt. It's not ready to go down the drain. Okay? And so if it is going to go down the drain and we can't have that assumption in place, then we need to use a different set of standards than we use for the average situation where we can assume that this is a going concern. The monetary unit assumption assumes that money is the common denominator, and which money are we going to use on the financial statements. So if this is a company that's using U.S. GAAP and U.S. standards from FASB, then the U.S. dollar is what everything is put in place. So if we're going to give a value on something, we give a value in U.S. dollars, and that's how it's reported on the financial statements. So if this company has various, if it's a U.S. company, but it has various factories or stores or whatever in other countries where they're making money in other denominations like euros or something, we have to translate that all back to U.S. dollars for the financial statements. We can't have bunches of different denominations on there. Periodicity assumption assumes that we can divide economic activities into certain time periods, such as months or years. So when we're doing accounting, we do the accounting for the entire month of March, and at the end of March, we kind of have a pause and we do our March adjusting entries. At the end of the year, we do our end of the year adjusting entries. And those can be pretty major, and whereas some interest that we're going to receive after the end of the fiscal year end, but we're going to put the part that we earned as of this end of this fiscal year. So we're saying that we can cut a timeline into a particular period from January 1st to December 31st, or whatever our timeline happens to be. Okay, here is a little exercise. Identify which basic assumptions of accounting is best described in each item below. So, letter A, the economic activities of FedEx are divided into 12-month periods for the purpose of issuing annual reports. So, that's the one we just talked about, the periodicity assumption, that we can divide these things into certain periods and it's okay. So this next one, Selectron Corporation, Inc. does not adjust amounts in its financial statements for the effects of inflation. Okay? That is the monetary unit. So we have learned that in some class or another, you have learned that the time value of money. We're going to go deep into the time value money in Accounting 202. But you know that $20 today is not the same as $20 10 years from now, okay? But on the financial statements, what I paid for a piece of equipment 10 years ago, that's the same number on the financial statements today. I'm not using, now I do use time value of money concepts for some things, but I don't use it for all things. And so some things in the financial statements don't have any effects of time value of money or of inflation. Our inflation here in the United States is very, very low currently and has been low for quite some time because the Federal Reserve here helps to make sure that it's low. But in other countries or at other times in U.S. history, inflation could be high, and you know that really affects the time value of money. It affects how much stuff is worth, and so but our assumption is that we can put this monetary U.S. dollar unit on there, and that there are no effects of inflation. That doesn't mean it's true. Okay. It just means that we're making that assumption when we make financial statements. The third one, Walgreen Company reports current and non-current, meaning long-term, classifications in its balance sheet. This is a going concern assumption. If we thought that Walgreens, or had some inside information that Walgreens was going to go down the drain tomorrow, then there shouldn't be any non-current long-term assets or long-term liabilities on its balance sheet because it's not going to last long-term. Okay? So that going concern assumption allows us to say, okay, well, we don't see any reason why Walgreens, shouldn't last a long time, and so we're going to go ahead and put current and non-current assets and liabilities onto their balance sheet. The fourth one, the economic activities of General Electric and its subsidiaries are merged for accounting and reporting purposes. Okay, so here's one of those where I told you the parent and the subsidiaries, and it there's all kinds of rules as to when the accounting of the subsidiaries are included or merged in with the parent and when they're not, and how that is done. Okay, And that's the economic entity assumption. So the assumption that we have a way of saying this is the business here. And so in this case, General Electric subsidiaries are part of the General Electric economic activities. Okay, principles, that was assumptions. Now we go on to principles. And principles, one of the big principles in accounting is a historical cost principle, which says that we're going to show certain things as what we actually paid for them. So as I mentioned before, what we paid for that piece of equipment 10 years ago is still on the financial statement as long as we still have that. Of course, now we are depreciating it year after year, and so we have the cost of the equipment minus the accumulated depreciation, but that original cost is what's on there. We're not looking at what that equipment is worth if we were to sell it. So that equipment might be worth more or less than what we have on the financial statement. But we're just going to show it at what it originally cost us. Now, why do we do that? Okay, we do that because it's more reliable. And we talked about how important it was to have reliability. Okay, if I put down what that piece of equipment was worth, it's just like, well, gosh, if I ask 10 different people what it's worth, even if they research it, they're going to come up with 10 different numbers. It's not very reliable. And so instead of just choosing some unreliable number, we just stick with the historical cost, even though that's not necessarily the best either. Fair value, meaning what it's worth right now, information could be more useful to the interested users who are trying to determine what's going to happen in the future. And if we knew this particular thing was either worthless or it was worth a bunch more than what's on here, that would be relevant information for us. Okay? And reporting of fair value information is increasing. There's some things like certain investments in which now we're required to report those in fair market value. And we'll be talking about those, I believe, in Accounting 202. The revenue recognition principle. This says, and this is the first part of the matching principle, which we have talked about in Accounting 101 and Accounting 102 and Accounting 201, okay? That we're going to recognize, recognition means we're going to record it into the books, okay? We're going to account for it. We're going to recognize revenue when it's either realized or realizable, means we expect to receive it in the future, and when it's earned. Okay, so the key point here is that we had to earn it. So if we sell products, that means we shipped the product. If we sell services, that means we actually performed that service. At that point, when we ship the product or perform the service, we have now earned that money. If the customer gives us the cash, well then fine, then we have realized that revenue. If the customer is going to pay us in the future, an accounts receivable thing, okay, that means it's realizable. We're going to expect to receive the cash in the future. Okay, but the main key point is that we recognize revenue, we record it in the books when we've earned it. If we haven't shipped out that product or we haven't done that service, we haven't earned that revenue, and it should not go in the books as a sale. There are, however, some exceptions. This is the first part of the matching principle.